It's been coming down quite quickly, and we can see now debt holders' percent of capital is about 50%, so that means 50% equity, 50% debt. So it's definitely going in the right direction. Their interest coverage now is up to 11.41, which is actually quite high. You want that above 3, so there's a good margin on that. And those numbers are all going in a good direction. The equity value per share has increased a lot, from 49 cents up to 5.19. I'll talk about that a little bit more later. And their rates of return are actually very good on common equity at like 50% for last year. So that's pretty astounding. And the earnings have gone from $1.39 to $3.29. So again, pretty consistent growth there. The return on assets, which I've talked about in previous videos, again have improved, and they're actually at 22%. So that is way above what their cost of debt is, which I think is about 4%, but I'll get to that. And that's mainly been, they've been holding their assets kind of steady, and their sales have been increasing, so the asset turnover has gone up. And also the income relative to sales, income's increased relative to sales. So the profit margin has gone up. Of course, you multiply those two together and you get your return on assets. So it's pretty hard to find a company that can get return on assets of 22%. Typically, an industrial type company might be 9, 10, 11%. Very good company. That's just some yearly charts. We'll go through that. And quarterly data. So these are my own numbers I put in from the company and my own kind of calculations. I projected a growth rate of about 9% a year for the next 5 to 8 years. Risk-free rate of 2%. That only gives a share price of $15, but that's extremely conservative, and it doesn't really apply too much now because of interest rates being so low. But the price to book is high, 10 times, but they are building equity, so that should start to come down fairly rapidly. But the price to sales ratio is very good. It's just 1 times. A lot of most companies, price to sales should be, if it's a low margin company, 1 or 2 times. A lot of technology companies now on NASDAQ, the high flyers are 15, 16 times, which is, no company can really justify that over a long period of time. So with the price to sales at 1%, I was pretty happy with that. That was another positive. I have lots of questions that I look at audit risk. I didn't really see any big problems there. My net liquidation on this company is still negative. That's kind of, if the company went bankrupt today, what would it be worth if operations stopped? And that's actually a negative $4. Not as bad as it sounds. Most new companies would be similar because they are doing acquisitions, and that's goodwill and intangibles. But their goodwill's been staying steady. It hasn't been increasing. And intangible assets have been pretty steady too, even with the small kind of bolt-on acquisitions they've been doing. So I'm not overly concerned about that, but I want to see the trend eventually go positive, and it's definitely going in that direction. So so there we go. Goodwill's been steady, hasn't increased. Their depreciation has been pretty steady. And then I think I've got on here, they were strongly cash flow positive, except for 2018 where it went negative. So I'll have to see where it is for 2019. I don't fully understand why it went cash flow negative. I know that what they termed it as, but I don't fully understand the accounting part of that for this company. And you can see they've got bank advances. I prefer, it'd be nice if they had their loans out for longer periods of time, but the rate they're paying is 4.15%, so that's pretty reasonable rate. It's not definitely not what you call high yield, high risk rates, which would be more up around 6 or 7%. So that looks like they have no problems getting financing. They do have quite a bit of cash and assets. Particularly, they kept this all in treasuries, but last year they started buying corporate bonds and some mortgage-backed securities. So that's level 1 is something they converted to be cash, like a treasury. Level 2 is like corporate bonds, that type of thing. So last year, 2018, they had 73 million in level 1, and then they had 197 million in like corporate bonds and mortgage-backed securities. So they've got to slightly riskier investments with their whole asset holdings, but there's nothing in the level 3. So again, I'm not too concerned about that. So that was just one company I kind of picked up, and I'm hoping with the use of options and there's not a big downturn in the market that I can keep this one hopefully for many years and just continue what I'm doing now. Once these options expire, hopefully I can redo them at a higher price and high enough that I won't have the shares taken away. Of course, if there's a big market correction that everybody's expecting at some point, a company like this could easily drop 20–30%. Because it still is a little bit on the overvalued side, and also if there's a recession, companies aren't doing quite as well. They don't want to go through a big change in their business, like setting up the whole outsourcing of their HR department, that type of thing. So that's basically that company. Time will tell, see how that plays out. As far as trades, I sold, which I'd mentioned before, and one I've had on and off, similar to me talking about AFC last week, but it was Trade Logistics, which is CHE.UN on the Toronto. I've been in and out of this one a lot, paid 11% dividend. I didn't really want to sell it, but it was getting to be a bigger part of my portfolio, so I thought I better have a look at some of the financial statements. I was a little unsettled with their debt and possibly maybe a dividend cut in the future, so I had a small capital gain and I received quite a few dividends at that 11% rate, so I decided to sell. That left a big hole in my portfolio because I own quite a few shares of that one. But like I said, I kept most of that in cash. The other one I sold was ARX.T, which I mentioned in the previous video. But it, again, I had a small gain on it and it was paying 8%. I picked it up after this huge correction from 34 down to 6. I started buying about 7. Mostly on TD's recommendation, which is pretty good for dividends. But my average line here, you can see, was about 6.6, got up to 8.5. But natural gas prices, I've said, are extremely low, lowest they've been in like decades. And it was trading in a band, and I thought, well, maybe natural gas prices will trade up. And when something's trading in a band, you never know which way it's going to break. It could break up, break down. The odds to me seemed it would break on the upside just because prices were so low. but they broke to the downside. That really concerned me about the profit margins on ARC. So I had a small gain. I think I got a few dividend payouts, so I got rid of that. Again, kept most of that in cash. One company I did buy was another gas line company in the States. Like I said, I've got Trans-Canada Pipeline now, I've got KMI.N, I've got IPL. So this is going to be like the fourth, just because that's where the dividends kind of are. And Morgan, KMI.T, share price has not been the best. They kind of overbought and paid too much for assets in the past decade or so, but now the price has kind of leveled out around the $22 area. They sold KMI.N shares that they had through various transactions, and they received $800 million in cash, and that they're using to pay down their debt. So they're trying to get their debt kind of back under control. The 5% dividend looks safe and probably will increase 4 to 5% a year. So I thought it was a good place to park some money. And it is one of the biggest oil, gas pipelines in the United States, shipping about 40% of natural